2008, you came to Fidelity as an analyst, and you had a number of years going through different sectors, as Maddie talked about. Analysts are judged on many things, but in particular, how well your buy recommendations work and how well your sell recommendations work. And it creates a chart that looks like a scissor. If it's a knife, you're not doing so well, but if it's a scissor, it's a really good thing. And that was a bit of foreshadowing for you because you did very well on both aspects of that. I'm sure you were thinking, I wonder if we'll ever long and short at the same time. Because at the time, Fidelity really didn't have any shorting ability, did it?
Correct. It was a 10-year program, and it's common for analysts to cover all the different sectors of the market before becoming portfolio managers. I think you've heard that a couple times today. And most of the time, so quantitatively, your compensation is driven by how well do your buys do, how well do your sells do. And with a long-only portfolio manager, really there's two types of stocks. Stocks to own, which is your buy-rated stocks, and stocks you can ignore, everything else. And for me, really the genesis of getting to where I am now is that when I was covering commodities, I covered forestry stocks when there was a Sino-Forest short report which was accurate and sunk the company. And so for me, talking to the short seller who developed that report, I actually talked to him a few weeks ago. I'm still in touch with him. Really sort of, for me, the light bulb went off that this is like, wow, this is like really interesting. Like, what's the difference between a stock that we could ignore, something that's middling, not as good as what we own on the long side, and what's something that's a short, what's something that's going to really disappoint people? And for me, it was just kind of following my passion, and fortunately the opportunity open to do it in a fund.
That is awesome. Now, Brendan was just up a session ago, and he was talking about the fact that you've been running this portfolio, long-short alternative, for 5 years. Many of us have heard advisors say, you're the best kept secret on Bay Street. I'd say that's less so now at $1.4 billion. It's also amazing to me the number of advisors who have said, I'd like to have a larger alt sleeve in my portfolio allocation, and they're working towards that, and they see you as fitting that bill. You became that portfolio manager with a variety of styles in your mind, and yet you went to Wharton and focused on value investing. Why? What happened?
For me, I did an undergrad at Laurier, and then I worked in consulting for a couple of years and then worked at TSX Group. So I actually spent a few years working inside businesses before going to business school. And I knew I was returning to an MBA program to pursue a career as an investor with a focus on public markets. And I do think that all successful investors, irrespective of their style, really understand the fundamentals of valuation, how to think about intrinsic value of businesses. Like Mark's a Columbia GSB grad, like home of value investing. It provides a really strong foundation, but as I got into doing the job, I also realized it's a big, exciting world. And finding stocks that had low valuations was only going to be one part about how I manage client money.
You didn't know what you didn't know. And then you get into the school of hard knocks of the real world, and you realize there's a huge opportunity out there. But it gave you a very good base. Then you became an analyst at Fidelity. And how did you refine your technique over the years? And then who were some of your mentors over that time?
Yeah, I think one of the great privileges of working at Fidelity is you get to learn from people who are really exceptional in their own kind of investing, whether it's, learning about how to think about growth stocks from, working beside Mark, or people who have more of a core strategy where you're really looking for that sort of, GARPy type growth, and also on the value side and really taking the other side of the trade. And, Hugo Lavallée has been really helpful to me about being able to buy stocks when things feel the worst. And as you cover different sectors, and I was an analyst for 10 years, you get to sample all of those moments. Like you get to be in the hot market where the stocks are flying. Yeah. You get to be in the room when it sounds like death and maybe the company's going to go bankrupt, and Hugo walks out of the room and makes a big trade and buys a stock because he's like, I think things are going to get better from here. And so really what you do is you collect these experiences and you start to say, what are the situations where I find success? and you take the individual skills that you've learned from those people and really try to put together a perspective on investing or an investment philosophy that is really true to yourself.
Very good. From a strategic investment standpoint, if I'm bearish on the market, should I say, hey, Dave Way can short the market, so I'm buying your fund? Or should I be buying you for the strategy, the holistic strategy?
I have lots of different types of conversations with clients. I would say the thing that is in common with the people who buy the fund are people who, really look at the return profile of the fund relative to the risk required to take it. And so for some people, it's replacing long-short equity strategies that maybe they've been unhappy with that relationship and they've seen, the performance of the fund in terms of, really generating equity-like returns at a significantly lower volatility. And other people have incorporated it as a core strategy. And I think what appeals to, that core category of thinking is that, and for a lot of these people, it's their first time adding a liquid alternative to the fund. And it's often a process of understanding how I manage money, and, long short sounds scary. But when you look at the actual performance of the fund and how it does in different environments, like partly born out of the fact that my brother is in the financial advice business. And one of the problems, and by the way, at Fidelity, when you become a portfolio manager, you have to have really good numbers for 10 years. And then you also have to have something to offer that is different from other fund managers and solves an important client need. And in my brother's case, he's like, the one thing that I would really like to have is something that keeps people invested through the cycle, where you do generate returns when things are good, but in particular when the market is volatile and clients are worried about the very short term and potentially risking longer term plans because they feel loss and fear. Like, it would be great to have a solution that can kind of hold people's hands through that process.
And it sounds like through our discussion so far, we're painting that picture, which is you're across styles and you can also long and short the market. So talk to us about the strategy of long short alternative.
The fund consists of two individual portfolios that are working together to solve the objective of, how do you generate attractive, equity returns, better than benchmark with lower volatility. The long portfolio, and really from a sizing perspective, it can be up to 150% gross, 50 short, and really 150-50, yeah, sorry. And really what that means is for $100 of client assets, I could be long $150 of stock and short 50. I've generally lived in, around the, 130-30 range.
Okay. Net
exposure of 80 to 90%. So really what that means is I have stayed around 80 to 90% exposed to markets and really trying to capture returns from the short portfolio, delivering returns when things are bad. And also the scissor chart you talked about, over time, there's also this less correlated return available from just having longs outperform the shorts. So as we look ahead, there's a lot of uncertainty. And from the perspective of the long portfolio, there is some uncertainty. And of course, it's the portfolio manager's job to manage through that. But what gives me a lot of comfort is that every day I know that I can walk into the office and be attacking the market through one of these three strategies. And only one of them really benefits from the market being up. If the market is flat or down, there's a part of my fund where I can be excited about, what's going to happen today.
You work in a team environment. It's your portfolio, but you work in Toronto with a huge team of people. There must be some jealousy from some of your peers, the fact that if it's a certain type of market, you can go short. If they're long only, they must look to you as having real great versatility.
I think you have to be a bit of a special personality to enjoy shorting. Like, nobody really wants to start their day hunting for bad news. So in some sense, some people don't enjoy looking at shorts and only want to think about what can go right. But it is true that during periods of volatility, it's a bit easier for me because I know that I'm going to have part of the portfolio working. And the thing that I like about it is in those times it allows you to operate from a position of strength. So if you could think about early April, the fund, I actually kind of thought tariffs were coming. And so the fund was well positioned for the news that really shook markets in early April. So I came into the office during the first week of April hunting for stocks to buy. Like what stocks have been really beaten up, where we can now either add to the position that I have and make it a full position, or bring new names into the fund where perhaps I was worried about tariffs, but there was a price that I was willing to pay because I think over 1 to 2 years, these could be really big stocks.
It's interesting. You talked about hunting for tough news. It's not that difficult these days because there's so much tough news, and so I'm sure you're finding lots of opportunity. How do you handle the geopolitical uncertainty that's happening right now? And what are your thoughts on it?
I think it's the biggest thing driving the market. It sounds obvious now, but I said this at a client event in December, and people were still thinking that like AI was going to be the big thing driving the market. And I really believe that we would see a material change in how the new US administration was going to engage with the world than really what we've experienced for 30 years. From a disclosed holdings perspective, one of the things that I thought would be an implication would be increased military spending in Europe. And so the fund, which can go up to 10% global, actually had some positioning around the world realizing that the US was less willing to provide a security blanket for Europe. And so this has been like a slow moving development, and I feel like it's probably accelerated in the public domain. Things like gold. Gold started to work last year. And for me, gold was one of the areas where I thought there could have been upside. And now, I covered mining, so I don't love miners. But there's lots of different ways to get exposure to gold without taking the risk of a country taking your mine, which, as a mining analyst happened to me all the time.
Yeah.
And so I think as we sit here, I think my message or outlook is the same as it's been for a few months, which is that we're likely to see tariffs at a lower level. In my head, I was thinking like 10 to 20% that the US will place globally. And there might be higher tariffs on certain countries where there are bigger geopolitical aims. So obviously, I think what happens between China and the US is a really important thing for sketching out what happens.
Talk about the access that you have, because you're meeting with companies all the time. You're going out to see them, they're coming to see you, but you also have a macro view. How do you do that research?
So I think it's really important to be macro aware. So I think about things like the traditional macro topics like interest rates, inflation, monetary policy. Those are like big themes. And so I sort of think of geopolitics as being a big theme. And I actually think in the current environment that what happens geopolitically matters more than what happens in the traditional levers of interest rates, currencies, because it matters, but it's coming from geopolitics. And so to me, I always try to run up the tree to the source of the issue. And in this case, I think it's geopolitics. So what happens to the Canadian dollar is really a function of geopolitics. What happens to inflation and interest rates is a function of tariffs, what happens with US deficit spending, and a few other things that are political in nature.
So you've been able to do all of this and maintain a medium risk portfolio. How do you maintain that? How do you have a keen eye on it? And how do you work to maintain a medium risk?
One of the things about being a short seller is that your mind is open to what can go wrong. And so a lot of times when I'm exploring a certain area of the market, I might actually be looking for a long idea. And I think one of the things that's actually unique about my investment process is that a lot of times when people are trying to get the conviction to buy a stock or this is a position I want to add, they really think about, what can go right? What are the risks to that upside case? And am I comfortable with that? I spend almost as much time, probably the same amount of time, trying to build the short case for stocks that I buy. Part of it is just I'm interested in it. And part of it is ultimately the returns of an individual position and the returns of the fund are driven by avoiding big mistakes. And so from a risk perspective, I would say that I have a very strong filter for what comes into the portfolio. from a factor perspective, like I'm style agnostic. I'm not leaning on growth or value, which can be cyclically like in and out of favor. Like you can make them lose money. I mean, the downside to it is I will never be, the best fund of the year because there will always be one style that, has an advantage. But I'm really trying to be the best fund over 3 and 5 years. And I think the way that you can achieve that is by having a more diversified approach to where you're looking for your best ideas. And I think the proof's in the pudding. Like when you look at the realized volatility of the fund relative to the returns, I think the risk is not a qualitative factor. It's a number, and that number is low. And so I think it's really an output of my process, the types of stocks I own, my diversified approach to finding ideas that allows for the level of consistency that the fund has achieved. And, every day I'm working harder to try to make tomorrow better.
Well, we like that. Can you take us through how shorting works and the team that you have at your disposal to help with that process?
We have actually very strong shorting resources. So internally, I get my ideas from analysts who have sell or strong sell recommendations on stocks. That's typically a list that I'm looking through, like, should I short this stock? We also have a dedicated short selling research team, and they spend 100% of their time, there's about 5 or 6 analysts, looking for short ideas. And more importantly, they give me really good leverage on my time, because sometimes what I'll do is I'll identify a group of 5 or 6 stocks and say, these feel like shorts, and I give them to an analyst. And like, can you take these away and come back and tell me which ones are shorts and which ones aren't? And, they do things around forensic accounting, maybe answer some, nagging questions that I have about the company, maybe host and set up a company meeting. And from there, I can really have a second opinion, really. And then there's also some third-party research firms. Like, these are not the people who post on Twitter, like, we're short company XYZ, the CEO is going to jail.
That's not how you make your decisions.
No,
Okay.
And don't listen to those people. They've bought put options the day before, and they've covered before the day's over. These are serious people looking at serious companies. They do not publish their research very broadly. And for me, like, the ideal scenarios where the fundamental analyst has a sell on a stock, the short selling analyst identifies some additional factors that makes it a good short, and I have a third party that's also recommending that I short the stock. And so then I just, I'm ultimately accountable for the decision about whether to short it or not. But, I feel like I've got family and support in making that decision.
Let's talk more about that. Why do you do what you do?
Well, I think, there's a few different things. The first answer is the selfish one. Like, I love this. I did it. I worked as an intern when I was in undergrad university in a couple of buy-side firms. And I really like the idea of, like, you just get to look at 100 companies every day. You get to bounce around industries and make decisions and take action. Like, I have a very deep intellectual curiosity about the world. I want to understand it. And this is a role where you get to do that every day. Yeah. And I think, from another motivation perspective, I have a 14-year-old son who has autism and a mountain of need later on. And so I have 100% of my money invested in the fund. And, my really only personal, financial objective is to, return as much as I can in this fund over the next 10 or 15 years to meet his needs. I used to say I drive a 6-year-old car, but it's 7 years old now.
Thank you for that. For the structure of the fund, number of names, generally capitalization mix.
Sure. The long side is 40 to 50 higher conviction ideas. Again, it's diversified across capitalization. I own some very large companies and I own some smaller companies. And the short side is similar. I will own some larger companies and I'll own some smaller companies. But there is a really important distinction between the two portfolios. On the short side, I have much smaller position sizes. Instead of having battleship shorts, where if the world changes, it takes you a long time to turn. It's a lot of small boats. And so you can actually build a short portfolio that is diversified and also has the ability to change when the market requires you to, so that really the overall fund performance is not impacted by any individual short.
I don't know if this is a fair question or not, but my mic's on, so I'll ask it. Do you ever get drama from companies from a short standpoint? You were saying earlier about meeting with companies that you may have a short position on. Does that create, that's a different vibe than when you're seeing companies that the firm and you are long?
Well, there's one company that I have a disclosed short position in as the last disclosure, and an affiliate of that company tried to have one of the short sellers killed. So I don't reach out to that company.
They're not.
And I'm not going to tell you the company.
Not here, are they?
No. So I generally avoid that. But in terms of the interactions with companies, obviously we're part of Fidelity, and I think that most companies should want to engage with short sellers. There's been a few companies that have followed, the fund and realized that I'm short the stock, and I always tell them I'm a possible incremental buyer. You should convince me why I'm wrong. And I think one of the things that really helps is that I'm not on Twitter saying this company's a fraud, the CEO's going to jail.
Right. You can have up to 10% foreign in long-short alternative. What have you done with your 10% and where are you?
It's moved around. I think it's really, for me, an opportunity to take advantage of where I work. So I sit beside portfolio managers that focus on global markets, and I'm always looking for ideas. There's no points for originality. And so if there happens to be a few ideas in an area of the market that I think are particularly interesting. So things like European defense last year, and also potentially in the year or two ahead, an improving outlook for Europe. For me, it's a chance to layer in 2 or 3 stocks that just have superior risk reward. If you look at a US stock and financials that trades at a really high price to book, it trades a high valuation. Growth has been good for many years, and perhaps, government spending and the outlook for the US economy might be, getting worse at the margin. Things might be getting better in Europe at the margin, and the stocks are cheap. So I still think there's something really special about being able to invest in North America. Canada has a bunch of great companies. The US has lots of companies. So they've got great companies and terrible companies that can get you exposure to a lot of these different global trends. But I do like to exercise that ability to go global. And the way I like to frame it for people is that if I'm trying to be right 55 to 60% of the time in the core fund, that's what leads to outperformance over time. That's what success is. I'm trying to be right 75 to 80% in the global piece, because it does take a little bit more work. It's a little bit outside of the core market that I'm following every day. And I think I've had that level of success. The answer might be, well, why don't you just be 80% successful in your big fund too? It's really about picking best ideas.
Yeah. It sounds like, from an equity standpoint, this is a jack of all trades type of portfolio because of the different capitalizations, because of the obviously the risk rating, and the fact that you can long and short, and you have a global opportunity as well. How's the best, in your words, how should an advisor talk to their client about long-short alternative fund?
I think the main value proposition of this fund is number one, unlike a lot of other long short funds in the market, there's no performance fee. Right. So you get the benefit, the unit holder keeps their returns. And I think that makes it very compelling versus other long short funds.
And sorry to stop you there, that's instead of it being paid out to the portfolio management group.
Yeah, right. That's why I drive a 7-year-old car. But I think the other piece, as you think about it versus your other core equity allocation, yes, it's a jack of all trades, but I think of it more as a diversifier. So to the extent you have growth or value managers that you're very comfortable with, this is a really good complement to those strategies, because it does invest, away from the benchmark. It does invest across a diversified range of styles. And I think most importantly, during periods of volatility, it's a hold your hand fund. It's a fund that you can rely on, hopefully, to provide a source of stability in your equity exposure. Because staying invested and not getting in the way of your own compounding and sticking with the plan, I think are the most important things that you can do for your clients, and something that I hopefully this solution continues to be able to provide as a possible building block of that capability.
So it fits into a portfolio, a diversified portfolio, as a key diversifier. It's one of the tools. Have you ever had a company that you were long that you re-rate and sell short?
Yeah, I've had a few companies where I've gone sort of flip-flopped. One of the companies that I was short TD. And the reason I went short TD is I felt that people were underestimating the implications of the anti-money laundering settlement. And it ultimately played out. People were underestimating the stock price reaction. And so the company sold off and created the opportunity to cover the short and then go long, because I felt that people might use the analog of what happened with Wells Fargo, which was basically 5 years of poor stock performance after similar sort of lapses. And TD is a bit different because they've got a US bank, a Canadian bank. They actually have places to move capital to generate returns. And so I felt that the market had overly punished them. So that's an example of where I've gone short to long.
We just have a couple of minutes left. What have you got a keen eye on right now as far as trends in the market?
So I think we covered geopolitics, which is really important. I think what's really interesting is that the U.S. housing market continues to kind of bounce along the bottom. We're at really low levels. Like if you just looked at like long charts of 50 years of history, the housing market is as bad as the 1970s. And it's been kind of 2 years of this. So what I'm really looking for are the companies that can benefit over the next 2 to 3 years from a recovery in housing markets. And that's one interesting thing on the consumer side. I also think that as we move through a period of tariff uncertainty and maybe beyond, there's a long-term trend still in place of consumer spending being around experiences versus things. And so there has been some dislocation around particularly travel that could be quite interesting. And Hilton has been a disclosed holding. As a stock, it's been a very strong performer over time. It's capital light. It's all over the world. And even if there's less travel between or across countries, there's still travel within countries. Mm-hmm. So you get these resilient stocks that just run into tough markets. Mm-hmm. And so to the extent you can buy these great companies at lower valuations in these periods of dislocation, that's great. Property and casualty insurance has been continued to be a strong market. I think Fairfax Financial has been in my top 10 for like 3 years. I mean, I just encourage you to model it over 5 years against the Mag 7. Like you would think these guys are in the data center business, but the reality is it was a very discounted stock. They've done a very good job on the underwriting side of improving profitability, and it remains a place where there's a lot of liquidity. So if some of the companies I invest in kind of look like the fund where you're like positioned to gain if things are good and have a lot of resiliency that if things go wrong, like you don't lose very much.
Your tenure as an analyst and success as an analyst is obviously translated into your success as a portfolio manager. And all that you've learned along the way has created, as you said, a wonderful diversifier for all portfolios. And so thank you for being here to talk to us about it today. Dave Way, everybody. Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.